In this lecture, we're going to talk about preferred stock. We're going to talk about some similarities and differences between preferred stock and common stock, and then we're going to go through some specific types of preferred stock. Some general features of preferred stock. First of all, they do receive dividend preference in front of common stockholders, which means they must be paid their dividend before common stockholders can be paid their dividend. They also have liquidation preference. In other words, if the firm liquidates its assets, the preferred stockholders must be paid the par value of their shares before common stockholders have a right to any residual assets. Generally speaking, preferred shares are non-voting shares. There are some exceptions to this, but typically only common shareholders have the right to vote. And then finally, preferred shares include a guaranteed dividend that's expressed as a percent of the par value, rather than with common stockholders where that dividend can vary and typically is not specifically tied to the percent of par value. There's actually some debate about whether preferred stock is an equity account or a debt account. And so really the debate kind of comes down to, does it meet the three elements of a liability? Of course, those three elements are a probable future economic sacrifice, a present unavoidable obligation, and a past transaction or event. And really the argument really hinges on whether there is a present unavoidable obligation. So with debt, of course, the interest payments and the subsequent repayment of a par value is unavoidable, and that's why you have a liability. With preferred stock, the vast majority of the types of preferred shares actually don't have that unavoidable obligation. The dividends related to preferred shares become an obligation only when that dividend is declared, because at that point the obligation is unavoidable. But up until that point, dividends and for sure the par value of the stock, they don't represent an unavoidable obligation, therefore they are not a liability, and so we treat them as an equity account. All right, let's go through a very basic journal entry. A firm issues 10,000 shares of preferred stock at $110 per share. They make this issuance for cash, and the stock has a par value of $100 per share. The journal entry is pretty straightforward. Of course, we raise $1.1 million. We assign the par value of the stock to the preferred stock account and any amount above par to the additional paid-in capital preferred stock account. I just want to highlight one thing very quickly, is notice that the issue price is very close to the par value. And that's the reason for this is basically that the preferred share, the value of that preferred share is really limited to that dividend. And so in this case, typically speaking, the dividend rate is going to be very close to what the market demands. And so therefore the issue price is going to be very similar to the par value. With common stock, the value really isn't limited to whatever a declared dividend rate is, but it's really a right to all future dividends, which includes the growth of the company. And so typically, because there's no set dividend rate that's tied to the par value of common stock, the common stock's issue price is usually much greater than the par value. And so that's kind of a big difference between the two, is what is typical in the issue price and the par value of the two types of stock. All right, there are several types of preferred stock we're going to walk through. First of all, there's cumulative preferred stock, which means companies must pay dividends in arrears, which means any dividends that were not declared in previous years. They have to pay all those dividends, including the current dividend, before they can pay a dividend to common stockholders. Most preferred stock has this feature. It just essentially means that once a year passes without the firm declaring a dividend, the firm is obligated to pay those dividends if they want to pay a dividend to their common stock shareholders. There's also participating preferred stock, which basically looks at this idea of a dividend rate. And this dividend rate is the dollar amount as a percent of par. And so like for common stock shareholders, their dividends usually are expressed as $1 per share, and some sort of dollar per share. So it might be 25 cents per share or $2 per share, whatever it might be. And so with participating preferred stock, they would look at that dividend rate on a per share basis and compare it to the par value per share. And the two rates must be at least equal to each other, or the preferred stockholders must have a higher rate if it is participating preferred stock. This is less common. The reason why is because it really constrains the ability of a company to pay a common stock dividend, because the par value of common stock is typically very low. And so let's make it simple. If the par value of common stock is $1 per share, and let's say the dividend rate for the preferred shareholders is even 10%, it means that the company could not declare more than a 10-cent per share dividend before this rider would kick in, and so it could really limit their ability to pay a common stock dividend. There's also convertible preferred stock, and that's a situation where the shareholders can convert their preferred shares to common shares at a predetermined ratio, and we're going to walk through an example of this. So a firm issues 1,000 shares of convertible preferred stock for $105 per share. The par value is $100 per share, and the shares are convertible at a 4-to-1 ratio. The par value of the firm's common stock is $1 per share. Record the conversion of 400 shares. So hopefully a fairly straightforward journal entry, but essentially what we're doing is we're taking preferred shares off of our books and issuing common stock in their place. And so similar to the past transactions we've seen, the issuance of common stock, of course those are going to be credits. And taking the preferred stock off of our books, those are going to be debits because their normal balance, of course, is a credit balance. And so in this case, the 400 shares times $100 per share, which is the par value, gives us a $40,000 debit to preferred stock. At issuance, there was additional paid-in capital of $5 per share that would have gone into our additional paid-in capital preferred stock account. And so we now need to take that amount out. And so 400 shares times $5 per share gives us the $2,000 in the additional paid-in capital preferred stock account. Common stock is credited for $1,600, and the reason for that is that 4-to-1 ratio. So that means that we're going to issue 4 common shares for every 1 preferred share. And so if we convert 400 preferred shares, that means we're going to issue 1,600 common shares. And since the par value of each share is $1, that's why we have a credit of $1,600. And then any amount above par is assigned to additional paid-in capital, common stock, which is where we get the $40,400. There are 2 remaining types of preferred stock. Number 1 is callable preferred stock. This type of preferred stock is a situation where a company or companies have the option to repurchase preferred shares at a predetermined price, and that price is usually some amount greater than the par value. It's an option, meaning that the company does not have to exercise the option, but they do have the option to repurchase the shares. Redeemable preferred stock is very similar to callable preferred stock, except that the repurchase is not optional. And so what that means is the firm is obligated to repurchase the shares at a future date at a predetermined price. And so in this situation, the preferred stock is actually listed as a liability under current US GAAP guidance. And the reason is because that repurchase is unavoidable. Now we have an unavoidable obligation. And so since it now meets that third criteria of a liability, we classify this account or this type of stock as a liability.